Hello everyone. Trust you're all in good health. Let's proceed with our ongoing conversation for today. We'll delve into the distinctions between ELSs, large-size entities, and SME'S, small-size entities. This subject holds significant importance and is frequently examined in many examinations. Let's carry on with our present discussion, focusing on SME'S. How do we characterize an SME? What criteria indicate that an entity falls under the SME category? Typically, SME'S are small businesses, often managed by the owner or a family-owned enterprise. Secondly, they possess limited financial reserves. Both their revenue and expenses are comparatively smaller than those of larger entities, and they also maintain a smaller workforce in comparison to their larger counterparts. Thirdly, they typically engage in less complex transactions. This contrasts with the more intricate measurements usually applied to larger entities. Continuing our discussion, certain essential exclusions exist in SME standards, outlined as follows. Initially, we'll consider earnings per share, as it is deemed challenging for SMEs to measure the fair value or market value of their shares. Secondly, interim reporting under IAS 34 is omitted for SMEs due to their small size and direct involvement of owners in day-to-day operations and reporting. Thirdly, when it comes to segment reporting under IAS 8, larger businesses typically have more segments. However, SMEs, being small entities, usually engage in a single operation, eliminating the necessity for segment reporting. Fourthly, asset held for sale under IFRS 5 is excluded for SMEs. Large companies engage in activities related to assets held for sale, while small companies typically do not participate in such activities, resulting in a lack of complex transactions. In the context of SMEs, certain accounting choices are restricted. These limitations are designed to streamline accounting practices and ensure consistency within the framework applicable to small and medium-sized entities. Firstly, goodwill. Goodwill is always recognized as the difference between the cost of the business combination and the fair value of the net assets acquired. In other words, the fair value method for measuring the non-controlling interest is not available for impairment and amortization of goodwill. Goodwill is amortized over its useful life. If the useful life cannot be reliably established, then management should use a best estimate that does not exceed 10 years for disposal. On the disposal of a foreign subsidiary, cumulative exchange differences that have been recognized in other comprehensive income are not recycled to profit or loss. Intangible assets must be accounted for at cost less accumulated amortization and impairment. Firstly, the revaluation model is not permitted for intangible assets. Secondly, for depreciation and amortization estimates are not reviewed annually. Changes to these estimates are only required if there is an indication that the pattern of an asset's use has changed. Thirdly, if an entity is unable to make a reliable estimate of the useful life of an intangible asset, then the useful life is assumed to be 10 years. Expenditure on research and development is always expensed to profit or loss. Investment property is remeasured to fair value at the year's end with gains or losses recorded in profit or loss. The cost model can only be used if fair value cannot be measured reliably or without undue cost or effort. Borrowing costs are always expensed to profit or loss. There are numerous simplifications with regard to financial instruments. These include, firstly, measuring most debt instruments at amortized cost. Secondly, recognizing most investments in shares at fair value with changes in fair value recognized in profit or loss. If fair value cannot be measured reliably, then the shares are held at cost less impairment. whilst associates and jointly controlled entities can be accounted for using the equity method in the consolidated financial statements. They can also be held at cost if there is no published price quotation or fair value. Therefore, simpler alternatives to the equity method are available.
Thanks for watching our video. For more such videos, please do subscribe our channel.